Welcome to Hidden Finance, the channel where economics and finance reveal their most hidden secrets. Support the channel by subscribing without missing any new mysteries revealed. Warren Buffett is one of the most influential and respected figures in the world of finance. Often called the Oracle of Omaha for his extraordinary ability to foresee and interpret financial markets, Buffett has become a reference point for investors, economists, and business people worldwide. But how did a man born in Omaha, Nebraska in 1930 become one of the richest and most influential people in the world? What was the secret to his success? And how did he transform his company, Berkshire Hathaway, into a financial giant? In this video, we will explore Warren Buffett's extraordinary career, his investment style, and his unmatched strategic vision. Warren Edward Buffett was born on August 30th, 1930, during a period of great economic uncertainty. From a young age, he showed a keen interest in business and investing. At just 11 years old, he bought his first shares in a company called City Service Preferred at a price of $38 per share. Although he couldn't trade in his own name because he was a minor, with the support of his father, Howard Buffett, he was able to complete this transaction. Shortly after, he decided to sell the shares with a modest 4.6% profit. While not a huge win, this marked Buffett's first step into the world of investing. After attending the University of Nebraska, Buffett enrolled at Columbia Business School, where he studied under renowned economist and investor Benjamin Graham. Graham is considered the pioneer of value investing, an investment philosophy based on buying stocks that are undervalued by the market. Graham taught Buffett the fundamental principles for identifying investment opportunities by analyzing company financial statements, revenues, and costs, seeking to discover the intrinsic value of a business. This education would be critical throughout Buffett's career. In 1956, at just 26 years old, he founded his first investment firm, Buffett Partnership Limited. Based on the principles he learned from Graham, this firm marked the beginning of Buffett's legend as an investor. In 1962, Warren Buffett decided to buy shares in a struggling textile company called Berkshire Hathaway. Founded as Berkshire Fine Spinning Associates, the company had merged with the Hathaway Manufacturing Company in 1955, but growing international competition and decreasing demand for American textiles had put the company in serious trouble. However, Buffett saw an opportunity. He noticed that Berkshire Hathaway was buying back its own shares, a move typical of solid companies looking to reduce the number of shareholders and increase the value of the remaining shares. Based on Graham's fundamental analysis, Buffett believed that Berkshire Hathaway's shares were undervalued compared to their intrinsic value. Nevertheless, this decision turned out to be one of the few misjudgments in Buffett's career. Buffett initially bought the shares at $7.50 each, but by 1965, when he took control of the majority stake, the price had risen to about $15. Despite his confidence, the company never managed to become competitive again in the textile sector. Rather than giving up, Buffett decided to transform Berkshire Hathaway into a financial holding company, gradually reducing the textile operations and starting to invest in other sectors. One of Buffett's first significant moves was the acquisition of GEICO, an insurance company that offered policies directly to consumers, cutting out intermediaries and reducing operational costs. Buffett immediately recognized the potential of this business model and decided to leverage the steady cash flow generated by insurance premiums to fund further acquisitions. For Buffett, insurance represented a unique source of liquidity, known as float. This term refers to the funds collected by insurance companies through premiums, which can be invested before they are needed to pay out claims. Thanks to this model, Berkshire Hathaway quickly began to expand into various sectors. Over the years, Berkshire Hathaway acquired significant stakes in companies like Coca-Cola, American Express, Washington Post, and more recently Apple, which today represents a substantial portion of Berkshire Hathaway's portfolio. Buffett's strategy, known as buy and hold, is based on purchasing solid, well-managed companies and patiently waiting for them to generate positive returns in the long term. A key figure in the history of Berkshire Hathaway and Warren Buffett's success is Charlie Munger, his longtime partner and friend. Munger, also born in Omaha and trained in law at Harvard, has had a significant influence on Buffett's thinking and investment approach. While Buffett had learned the analytical rigor of value investing from Graham, Munger persuaded him to also consider other factors, such as management quality, brand strength, and corporate reputation. A notable example of this new philosophy was the acquisition of See's Candies in 1972. The company's financials didn't seem to justify the purchase, but Buffett and Munger recognized the strength of the See's brand, which had an emotional connection with American consumers. The acquisition proved to be a success, bringing Berkshire Hathaway enormous profits over the years. In addition to the lessons from Munger and Graham, Buffett has always paid close attention to investor behavior and market sentiment. By using tools from behavioral economics, a relatively new field that analyzes how emotions and cognitive biases influence economic decisions, Buffett has been able to make the most of market crises. A striking example was the purchase of American Express shares in 1995, when the company was hit by a major financial fraud scandal that caused its stock price to plummet. While many investors fled, Buffett and Munger realized that the American Express brand was still strong and that most customers would not abandon the company. The decision to invest at that time proved incredibly profitable. Today, Berkshire Hathaway still holds American Express shares worth over $36 billion. With Warren Buffett's advanced age, a recurring question among investors is who will take over Berkshire Hathaway. In 2021, Buffett designated Greg Abel, current vice chairman of Berkshire Hathaway and CEO of its energy division, Berkshire Hathaway Energy, as his successor. Abel has demonstrated impressive strategic vision and management skills, successfully expanding the company's operations in areas such as renewable energy. While it's hard to imagine Berkshire Hathaway without Buffett and Munger, their legacy and the long-term investment philosophy they created will remain at the core of the company's strategy. Buffett has often emphasized the importance of maintaining transparent management and aligning shareholder interests with those of leadership. Under Abel's guidance, Berkshire Hathaway seems poised to continue its path of success. The story of Warren Buffett and Berkshire Hathaway is a testament to the power of patience, intuition, and long-term strategy. From his first stock purchase at age 11 to building a financial empire, Buffett has demonstrated that success in investing is not just about numbers, but also about understanding human dynamics and market behavior. The main lesson we can take from Buffett's career is that investing is not a short-term race, but a process of accumulating value over time, based on solid analysis and trust in companies with strong fundamentals. And as we prepare for a future without Buffett and Munger at the helm, we can be certain that their legacy will continue to influence and inspire investors around the world. If you enjoyed the video, leave a like and subscribe so you don't miss the next mysteries of the economic world. But what's your opinion? Share it in the comments.